Welcome to this explainer. Today, we're diving into a genuinely fascinating historical mystery, the enduring, almost stubborn grip that gold has on our modern global economy. I am so thrilled you're here, because we're going to connect some massive historical dots. We'll look at the actual money sitting in your wallet right now, the heavily guarded vaults under our global central banks, and the shiny metal that humans have obsessed over for, well, centuries.
So let's explore this bizarre paradox. Really think about it. Gold doesn't manufacture anything, right? It doesn't pay you interest, it doesn't create jobs, and it certainly doesn't innovate. And yet, virtually every major country on Earth still keeps thousands of tons of it locked away in highly secure, subterranean vaults. Why? Why are central banks continuing to hoard it today? To truly understand the modern financial system we're all operating in right now, we have to solve this mystery. We need to figure out why humans chose this specific metal in the very first place.
Which brings us to our first chapter, the origin of trust. To understand the fiat money in your wallet, we first got to travel back and look at how gold solved the ultimate headache of ancient trade. Early human civilizations desperately needed a reliable system to exchange goods, and gold naturally won the lottery here because it checked almost every single box for what makes good money. You might wonder, why not iron? Well, iron rusts. What about diamonds? Try dividing a diamond to buy a loaf of bread. But gold doesn't rust. It's incredibly durable. You can easily melt and divide it. It's portable, it's really hard to fake, and crucially, this is the big one, it is extremely limited in supply. Because physical gold naturally possessed all of those perfect properties, it generated immediate, undeniable trust. Imagine two strangers from totally different empires meeting to trade. They didn't need to speak the same language, they just needed to trust the gold. Because of this, it organically evolved from a raw, traded metal into actual minted money. Kingdoms just started stamping it into coins, creating a universally trusted foundation for global commerce.
Okay, let's move into the next phase, the paper promise and the gold standard.
As global economies exploded in size, hauling around heavy bags of physical gold became completely impractical. Imagine trying to buy a massive shipment of goods and having to literally transport wheelbarrows of heavy gold coins across the country. Total nightmare, right? It was dangerous and wildly inefficient. As a solution, banks stepped in. They started storing that heavy physical gold securely in their vaults, and in exchange, they issued lightweight paper notes. These paper notes were basically just direct claims on that securely stored gold. You could carry a piece of paper in your pocket, knowing you could walk into the bank at any given time and swap it back for the real physical metal. This clever mechanism naturally evolved into what we call the gold standard. Under this setup, the value of a nation's paper currency was directly linked to a specific, defined quantity of physical gold. And this is the key takeaway here. This created massive global confidence. Governments couldn't just fire up the printers and make unlimited paper money because they were severely constrained by the actual physical gold reserves they held. If they wanted to aggressively expand their money supply, they literally had to have the gold in the vault to back it up. All right, moving on to the era of the global anchor. Now, what's really fascinating here is how the sheer devastation of World War II completely forced the world to desperately seek out a brand new, stable financial framework to rebuild international trade. Following the timeline of events, in July 1944, with global economies basically in ruin, leaders from dozens of nations met at the Bretton Woods Conference in New Hampshire. Brilliant minds, like the famous British economist John Maynard Keynes, sat down to establish a totally new international monetary framework. And because the United States emerged from the war holding a massive chunk of the world's official gold reserves, this agreement effectively pivoted the entire world onto a US dollar-centric system.
Here is exactly how it worked under Bretton Woods. Instead of every single nation linking their own currency directly to physical gold, which honestly many just couldn't do anymore because their reserves were totally depleted, they tied their money to the US dollar. The US dollar, in turn, served as the ultimate global anchor because it alone maintained that direct link to gold. Basically, if you held dollars, you held a proxy for gold.
But things didn't stay that way forever. Let's look at the break, the Nixon shock. By the late 1960s, a major systemic problem started bubbling beneath the surface. Global trade was expanding at such a rapid pace that there were simply more dollars circulating globally than the US could comfortably back with the gold sitting in its vaults. The math just wasn't adding up anymore. This unbearable pressure led directly to the infamous Nixon shock. On August 15, 1971, U.S. President Richard Nixon totally shocked the financial world by abruptly suspending the dollar's convertibility into gold. With one single speech, the Bretton Woods system was dead.
This one historical event permanently transitioned the entire globe into a new era, the era of fiat money. The absolute value of our currency completely shifted away from physical metal.
Think about it. Under the gold standard, value meant physical reserves you could touch. Today, with fiat money, the value of that cash in your hand relies entirely on your trust in modern institutions. It's based on government backing, the strength of the legal system, and overall public confidence.
So, because we no longer have that gold peg, how exactly is the money in your wallet valued today? Well, global currency values are now constantly adjusting based on this incredibly complex web of economic fundamentals. When you look at exchange rates today, you're actually watching a real-time measurement of things like inflation, interest rates, economic growth, and even raw political stability. Supply and demand in the foreign exchange markets dictate exactly what a currency is worth on any given Tuesday. Gold is no longer steering the ship. The broader economic system is.
Which finally brings us to the resolution of our mystery: modern central banking.
Okay, so if fiat money isn't backed by gold anymore, why on earth do central banks still relentlessly buy it? When breaking down modern reserve strategies, the answer is simple. Central banks just don't put all their eggs in one basket. They hold foreign currencies because they're highly liquid. They hold government securities because they actually earn a yield, but they still hold physical gold to diversify their assets because, unlike a government bond or a foreign currency, physical gold carries absolutely zero credit risk. It doesn't rely on some other government's promise to pay you back. It's simply a valuable asset all on its own.
The big takeaway for us here is that gold's role hasn't disappeared. It's just evolved. Even though it's no longer the actual foundation of most modern fiat currencies, it has firmly retained its ancient reputation. Gold remains this vital, stable anchor that countries heavily rely on during times of intense economic uncertainty. When the complex web of modern finance gets shaky, nations absolutely still want that shiny, indestructible metal resting quietly in their vaults.
Gold has dominated the world for centuries, providing trust, enabling trade, and anchoring the global economy through massive wars and financial crises. But today, the world is shifting once again. With the massive rise of decentralized digital transactions tied to an asset that is mathematically limited to exactly 21 million coins, we're left with one massive, provocative question for our next explainer. Can Bitcoin actually replace real gold? Is digital scarcity the new vault? Think about that for a bit, and I'll see you in the next explainer.